Previously, we discussed two strategies, the bull spread and the bear spread, that use call options. And the bull spread is a way to bet on the price going up for the stock, and the bear spread is a way to make a bet on the price going down. Now we're going to talk about another strategy called a butterfly spread. And the butterfly spread is a way to make a bet that the stock price stays within a certain range. So for instance, if we look at the actual price here that's simulated for this stock SPY, we see that it's projected on average to end somewhere around $380, $378. So we could make a bet using a butterfly spread that the stock price finishes somewhere close to that range. So here's how that would work. We would buy one call option, then buy another call option with a higher strike price, then sell two call options with a strike price in the middle. So here's how that would work. We've got two options up here already that have been used for other strategies, and we can still use those. So we can make the strike price of 400 the option with the highest strike price, 380 one in the middle, because that's close to what's projected for the price here. And then we'll use a call option with the strike price of 360 as the lower strike price option. So we need to look up the market price for this 360 strike price option. And right now it is at about $30.85 as of when these prices were obtained. Okay, so here's how we'll set up the butterfly spread payoff. First, we're going to buy the lower strike price option, the one that has a strike price of 360. So we're buying that option, so we would expect to receive the payoff from that option, which will be the actual simulated price minus the strike price, in this case 360. And then we always discount this payoff to present value. Discount factor is the exponential function with the negative sign times the risk-free rate times the time to expiration. And then, of course, we have to purchase this option, so we're going to have to pay the market price. All right, the second option that we're going to purchase is the higher strike price option with a strike price of 400. So the payoff for that one would be the simulated actual price minus that strike price of 400. And then we discount it. Discount factor is the exponential function with the negative sign there, times the risk-free rate, times the time to expiration. And we're also purchasing this option, so we're going to have to pay the price of that option. All right, now we're going to sell two options with the strike price in the middle, and we're going to use the strike price of 380. So if we're selling this, we're going to receive 2 times the market price because we're going to sell 2 of these. And then our payoff, we're going to have to pay that out because we're selling the option. So 2 times the payoff for this option because we're selling 2. The actual price minus the strike price, and then times the same discount factor. And so, fairly complicated formula, But the bottom line, if we review this formula, what's happening here is here's the payoff from buying the first option minus the price, the payoff from buying the second option minus the price. We're selling the two middle strike price options, so we receive 2 times the price, but we pay out 2 times the payoff. And so that is the butterfly spread. If we just look here at the cost would be, just to analyze that part, the cost would be we purchase the low strike price option, we purchase the high strike price option, but this is offset by 2 times the price of the option that we're selling. So one thing that's attractive about the butterfly spread is that it has a very low cost. If we don't think we're going to see any major swings in the stock price, this might be an option that locks in some return. So we'll make this an output. And simulate this. All right. So it's pretty interesting if you look at, not unusual with these option strategies, the mean is very close to 0. So we're always making a bet, really, that the stock price ends in a certain range. The minimum payoff here, though, is just the cost net of these 3 options, and then the maximum is 1740. But let's look at what the profile of this looks like. So let's create an overlay. We'll go into the actual price output here and create an overlay. And so we'll go down here and add an overlay. And the overlay is going to have the actual price and a comma and the butterfly spread. Okay, so that's what the overlay looks like. Main reason we create the overlay, though, is to export the data. So if we go over here to export and export to Excel, and we'll use a new worksheet in the active workbook. So I'll rename this tab Butterfly Data. Now I'm going to copy these actual price and butterfly spread labels. And then we're going to sort these 1,000 iterations from the simulation. We're going to sort them by actual price. So we'll go to Data and Sort, and then sort these by the actual price. Okay. Now, these columns are already highlighted with the headers, so it's very convenient to make an XY scatter plot. Go to Insert, and then over here we have XY scatter plots. And probably the best one would be this one with the smooth lines. All right, so here we have the graph of the butterfly spread. The actual price is on the horizontal axis, and then this is the payoff of the option strategy. So we can see that the lowest this would pay off would be 221. If the stock price ends below 360, we're just going to lose the cost of the strategy, 221. You can see that over here. If the stock price goes above 400, we're also going to lose the cost of the strategy. But in between 360 and 400, we're going to have a positive payoff, at least a little bit above 360 and a little bit below 400. We still have to recover some of the cost. But if the stock price stays in a range right around 380, we stand to make the maximum payoff, about 17. And so that is how you can use a butterfly spread to lock in a payoff in a certain range. And you can adjust the strike prices of the options and use different options to move this range to where you think the stock price might end up on the exercise date.